Olá, pessoal. Bem-vindos a mais um episódio de Conversa de Fundos. E hoje a gente tem aqui dois convidados muito especiais. A gente vai falar sobre crédito em mercados desenvolvidos. So switching to English because our guests are foreigners. Thank you so much, Mike and Nishil, to have you here with us in this episode. So Mike is the Chief Investment Officer and Head of Underwriting for Carlyle's U.S. direct lending business. And Nishil is the Global Head of CLO Investment at Carlyle. A lot of different acronyms and topics, but we're going to touch base on all of those. And we meant to do it in a very didactic form for you guys to understand what they do, which is a lot. So, Mike, could you please give us a little bit of background on your history, what you've done?
Sure. Again, and thank you so much for your time today. I'm primarily focused, and my team is primarily focused on delivering safe and defensive investments in the credit space. I'm primarily focused on sponsor-backed portfolio companies that we consider to be middle market. So these are borrowers with EBITDA or cash flow of between $25 and $125 million. We focus on being a consistent provider of financial solutions to business of that type. It's high volume and very interesting and delivers what we feel are an outstanding return profile potentially to investors.
So how long have you been doing this?
I've been on the buy side since 2000. So for 24 years, I was on the liquid credit side of the business for 19 years of my career and been entirely focused on private credit and direct lending since 2019.
Wow, nice. Yeah. And so Nishil, could you also give us a background?
Yeah, and thank you so much for the time today. So as Carolina mentioned, I'm the global head of CLO investments at Carlyle. We are part of the larger Carlyle credit team, which is $190 billion of assets under management. Within that, liquid credit is about $53 billion. We are the world's largest manager of CLOs, or collateralized loan obligations, which are effectively diversified portfolios of first lien loans to very large companies. These companies typically have average earnings of $700 million, average loan size of $1 billion. And so what we are doing is investing in these CLOs managed by all the large fixed income investors globally, both in the US and Europe.
So how long have you been doing this, Nishil?
Yeah, so I've been in and around the CLO space for the past 21 years now.
Nice, nice. So we are going to talk today about CLOs and direct lending businesses. Just let's start with CLOs. So you just mentioned what CLOs mean, but could you explain it in a very, very, very easy way for us to understand?
Sure.
It's not that difficult, but it would be a great opportunity.
I'll try my best. So as I mentioned, these are diversified portfolios of 200 to 300 loans to these very large companies, industry-leading companies. As I mentioned, $700 million of earnings on average, $1 billion plus facility sizes. And these are typically private companies, but also public companies as well, typically rated BB and single B. So these companies that are borrowing these loans are also the same companies that you see in the high yield space as well. There's significant overlap there. And CLOs require significant diversification. As I mentioned, 200 to 300 individual loans, largest exposure to any single loan being less than 1%. Industry diversification is required, typically maximum industry exposure of 12 to 13%. So when you're investing in a CLO, you're getting broad exposure either to the US economy, if it's a US CLO, or the European economy, if it's a European CLO. And the CLO market, it sounds like a new market, but it's actually a 25-year market that's over $1 trillion in size in the US today. So it's become a much more mainstream asset class that a lot of investors are allocating to, whether it's through their fixed income allocations or alternative allocations. And why CLOs are important is the broadly syndicated loan market, which is $1.4 trillion in size. CLOs represent 70% of the buyer base of that market. So to really have a functioning U.S. capital markets, you need to have a functioning broadly syndicated loan market, and to have a functioning broadly syndicated loan market, you need to have a functioning CLO market.
So it's a huge market.
Correct.
So Nishil, one of the things that I find interesting in this market is that CLOs are pretty standardized. Like, can you talk a little bit more about these standards? Because in Brazil, we don't have like an asset that's standardized like this one. Like the quantity of loans,
Sure.
the tranches, and also talk about the liquidity of it.
Yeah, so you typically have standard features across all CLOs. So CLOs effectively is the financing to purchase these 200 to 300 loans. And these financings are rated by the largest rating agencies, so Moody's, S&P, and Fitch. And to achieve those ratings, there are certain requirements that need to be met. So we talked about the diversification requirements, but there's also different requirements in terms of how the capital structure is allocated. What I mean by that is 65% of the CLO is actually rated AAA. So the world's largest banks, world's largest insurance companies, they buy these AAAs as really a cash substitute. Their treasury departments are buying it. And then you have the AA, single A, triple B, double E, and all the way down to equity as well. We are actually active throughout the capital structure for the different funds and accounts that we have. But what we see as the best relative value today is really the double B tranche. And so while you have all these key standardization, the one thing that makes CLOs unique is that the structures, they're not all identical, and the documentation is highly negotiated. So that's why you need a large team that has deep expertise in CLOs to understand the documents and structures. And then also you need a very large team to properly underwrite the 200 to 300 loans. And that's where we benefit from being part of the larger liquid credit team. So I mentioned earlier, Carlyle is the world's largest CLO manager. So whenever we are investing in a CLO, we have over 30 credit analysts, 5 portfolio managers. We can use their credit expertise to underwrite the portfolios as well.
Did we mention how much Carlyle have on this business? I don't think so.
Yeah, so we have over 50 billion in assets under management related to CLOs today.
So nice. So these are floating rate assets. So how you see the demand for this kind of assets in today's environment?
Yeah, so they're floating rate based off of SOFR. And so we think it's a great complement to fixed income portfolios. Because if you think about fixed income portfolios, they're fixed rate. That's why they're called fixed income. But CLOs are actually floating rate. So it's a great way to diversify the U.S. interest rate risk that we've seen. We've seen over the past 2 years, interest rates increase substantially. And as a result, the value of these fixed rate investments decline substantially. You don't see that issue in CLOs because they are floating rate. The other benefit is since CLOs have a low correlation to fixed income asset classes. On a 5-year basis, negative correlation to treasuries, US treasuries, and only a 20% correlation to the Bloomberg Aggregate Bond Index. It's a global bond index that most fixed income investors are benchmarked to. And given CLOs are $1 trillion asset class, they're also CUSIP securities. What does that mean? They trade and settle just like stocks, investment grade bonds, or high yield bonds. So there's a very robust secondary market that allows us to source and trade these CLOs on a frequent basis.
Can you give us an idea of like the daily liquidity of a liquid tranche on CLO?
Sure. So the overall trading volume last year was around $200 billion out of $1 trillion asset class. So a very robust liquid market.
Yeah. And you mentioned earlier that we see some investors rotating their portfolios from high yield bonds to these kind of structures. How you see this movement and how do you compare those kind of assets? They are different, of course, but how you see the parallel?
Yeah, so as I mentioned earlier, the actual companies that you have exposure to are very similar, both in the high yield asset class and the broadly syndicated loan asset class, which is ultimately what CLOs invest in. The key difference, and there's several, one, if you think about a capital structure for a very large company, the first lien loan is the top of the capital structure. What that means is if there's a restructuring or a bankruptcy, the loans are first to get repaid, then the high yield bonds, then the equity. So if there is a trouble, the loans have a higher recovery rate typically than the high yield bonds. So that's number one. Number two, specifically to CLOs, is even though CLOs are $1 trillion asset class, it's not very well known to a lot of investors. It's becoming more well known, but it's not as well known as high yield bonds or just the underlying loans. And there's a complexity premium. CLOs typically generate yields and spreads that are 2 to 3 to 400 basis points higher than high yield or broadly syndicated loans. And that's been fairly consistent over the past 11 or 12 years since the financial crisis.
Good. And those assets are in high demand today. The investors have been searching for it. How do you see how these have been affecting the spreads of these assets?
Sure. So you've seen spread compression throughout fixed income markets globally. Right now, high yield markets, investment grade bonds, they're all trading very tight compared to the historical averages. And as a result, you've also seen spread compression in CLOs as well. So just an example, CLO double Bs today, you're seeing a yield of around 10.5 to 11%. But that's going to come down as the U.S. Fed cuts rates. But on a yield to maturity, so incorporating expected rate cuts, you're still expected to receive 9 to 9.5% returns. That compares to 7% for high yield bonds today, or less than 5% for investment grade bonds. So even though rates are declining, we think on a relative value standpoint, CLOs can be very attractive.
So, Nishil, some investors, they are sophisticated to the point that they go to the CLO trenches directly. And we also see in the market solutions where you have diversified portfolios of CLO trenches like CLO BBs, as you mentioned. Which would be the advantages of investing in a diversified portfolio that's managed by a professional asset manager?
Yeah, so when you're investing in the CLO market, there's a lot to choose from. What I mean by that is there's thousands of CLOs outstanding, both in the US and Europe. And then these CLOs are managed by the largest fixed income managers in the world today. There's 150 to choose from in the US.
Wow.
There's over 60 to choose from in Europe. And then as I mentioned, Carlyle is actually the largest one today. But so it takes a lot of analysis and diligence to properly pick the right manager to partner with and the right CLO to partner with. And so when you're investing in a CLO directly, it's going to be very difficult to one, create the diversification. Because yes, you could buy 5, 10 CLOs. Typically, when we are creating portfolios, we are allocating to 20 to 30 different CLO managers. We typically have anywhere from 50 to 100 positions within a portfolio to create significant diversification.
Yeah, good. So good. So Mike, now let's talk about direct lending.
Right.
So could you explain to your audience what direct lending is and what kind of solutions are there in the market?
Sure. Direct lending is interesting because it's really what we thought of as banking 30, 40, 50 years ago. We are providers of loans directly to largely sponsor-backed businesses. Typically, it's a 3 to 5 member bank group, as opposed to the very large 20, 25 plus bank groups we see in the broadly syndicated market. And it's very much old style lending. We have teams of originators who engage directly with portfolio companies as well as financial sponsors to help them meet their financing needs. So we work with the sponsors for the initial M&A transaction, and then we continue to work with the sponsor as well as portfolio companies for any incremental borrowing needs that they may have. Why would you borrow additional money? Mergers and acquisitions, largely refis, growth initiatives, they come back to us frequently to address their capital needs. And that's why the direct lending market exists. It's speed, it's certainty, and we're a consistent partner to our financial sponsor clients.
Yeah, and we have also seen a growth in this market, like on the fund solution side, and like different investors, different asset managers, they tackle into different kind of companies. Can you talk a little bit about that?
The market is divided into three main segments. First, there's upmarket. Upmarket are really the borrowers over $150 million, and typically these borrowers are of size such that the general bank market or broadly syndicated market meets their financing needs. There's also a group of direct lenders who focus on this market. There may be 5 to 7 globally who are focused on large upmarket transactions. Those transactions typically offer less of a premium relative to the traditional broadly syndicated market. And they also generally offer fewer structural protections. By structural protections, I mean covenant package, EBITDA definition, so on and so forth. So that's one part of the market. At Carlyle, we focus on, again, the core middle market. So borrowers between $25 to $150 million in EBITDA. At the time of an initial underwrite, an average EBITDA may be roughly $50 million, 5 to 6 times leverage. So at that point, we're looking at a capital structure comprised of a unitranche term loan. And it's unitranche because there's only one tranche of debt. There are not multiple tranches. There's no junior capital. So that's, call it $250 to $300 million term loan. Often there's a smaller revolver attached. And again, 3 to 5 participants within that deal. There's also the lower middle market. And those are borrowers who are below $25 million. They tend to offer the same premium as the core middle market and the same documentation features, but again, the lender group is quite small. Typically, those deals are one lender, so a sole lender, or maybe two. And those are really the three parts of the market. There's robust competition in each, but I'd say the most competition, again, is upmarket, where the firms are competing against themselves as well as the banks. Core middle market, less competition, and lower middle market still, I'd say a few players.
So for the size of the portfolios you manage and the size of the tickets, you analyze like several deals. How many deals do you diligence, like a month?
Well, if we look at our origination pipeline, we see roughly 1,500 new deals a year. So there are a lot of deals, a lot of deals to look at. And if you think about, call it our hit rate or our investment rate, for us, it's roughly 3% a year. So we see a lot, we diligence a lot, we invest in very little. Now, there's several reasons for that. It could be the credit quality of the borrower. It could be that we are not aligned into particular sectors. There are obviously sectors we may like, and there are sectors that we may like less, and that plays into it as well. And then finally, it's a sponsor market. We're supporting financial sponsors in many cases as they bid for companies. Well, those are competitive bidding processes, and as much as we'd like them to, our sponsors don't always win. So you are going to look at a significant number of deals where someone pays more than your sponsor, perhaps a strategic comes in and buys the business, they can pay a lot more. So there are all types of reasons why a particular hit rate may be lower, but it's a fast-moving market, a competitive market, and you don't always win.
Yeah. And like those structures, they yield something close to 10% a year, which doesn't look so absurd in today's market. But when we see the interest rates in US or Europe some years ago, it seems a lot. Is this sustainable?
We found that it's been sustainable. People invest in direct lending because it offers a through-cycle premium of 150 to 200 basis points over the broadly syndicated market. So that's the premium. And that is a through-cycle premium specifically in the core middle market. So a conservatively managed core middle market direct lending portfolio should be able to achieve that 10% plus yield through cycle. And certainly if you think about our funds at Carlyle, we've managed to achieve that when base rates were high, base rates were close to nothing. So we feel like it's very achievable going forward.
Yeah, you've been one of the firms that have been doing this for a long time, right?
We have. We've been in the direct lending business since 2013. and our funds on offer are some of the most seasoned funds in the marketplace. So we've been doing this a long time. We have a lot of data through various market cycles, and we feel great about our ability to achieve those types of returns going forward.
Good. And now it wouldn't be interesting if I didn't do a trick question for you guys. So the kind of solutions that you manage are liquid ones, like semi-liquid ones. How you see the liquidity of this market, of the funds in this market? Like sometimes when we talk to investors, they're sometimes worried about this. Can you touch on this on the direct lending side and on the CLO solution side?
Well, what we've seen, and again, I've been in the business since 2000, is all markets trends towards liquidity. So even private markets eventually become liquid. Certainly,
thank God, right?
Right. When I started at Carlyle, the private equity team could never imagine that they'd be able to trade in the secondaries. So all this is new, and certainly in direct lending, we're at the early stages of seeing liquidity in our market. And that comes from a few sources. First, traditional banks want back in on the market. And one of the ways they can help and be relevant is to provide liquidity, certainly for the larger upmarket style financings. So that's something that's happening now, and that's new liquidity. Second, many direct lenders have established capital markets desks that, among other things, distribute risk that they may hold. Perhaps they're an agent, they may have an outside hold. They're happy to syndicate that risk or sell that risk to others in the market. We're seeing that more and more. And it offers liquidity. So would anticipate our market, it'll remain a private market, but there will be increasing sources of liquidity on a portfolio basis. And from a portfolio management standpoint, we certainly have methods to provide liquidity to our investors. Loans generally have regular repayment schedules. That's certainly a source of liquidity. To the extent you conservatively manage the balance sheet, and you have additional debt capacity, that can provide investor liquidity. So liquidity is improving. It's still very much a buy and hold market, but those liquidity solutions are on offer.
Good, thank you.
Yeah, and then CLOs are slightly different in the fact that they are securities. You have a very robust market, 200 billion of trading volume.
This is a liquid market in the US.
It's a very liquid market. So because the underlying investments are liquid, we can create funds and accounts that provide liquidity as well. So slightly different than the direct lending market because they trade T+1. There's very active trading markets. There's about 30 different investment banks that trade these securities. So very robust trading.
Yeah, it depends on the tranche you are at, right? If you're in the CLO equity, maybe not so much, but in the CLO BBs, yes, right?
Yeah, so different parts of the capital structure will have different liquidity. You're 100% correct. On the equity, liquidity can evaporate during periods of volatility. Yeah. But what happens is with CLO debt, we've actually seen trading activity increase in periods of volatility. So when you look at trading volume in 22 and 23 when there was volatility in the credit markets, or in March of 2020, the onset of COVID-19, liquidity actually increased instead of declining. And so that's a key feature that we look at when trying to structure funds that provide liquidity to investors.
So, and one final question, if you would give like one feature that an investor should pay attention to when diligencing or analyzing the kind of fund you manage, what would it be? Direct lending and CLO.
Yeah, maybe I'll start off, Mike. So I talked about, and similar to what Mike said, is CLOs have provided 200, 300, 400 basis points of spread premium and return premium compared to high yield and loans for about a 12-year cycle. So through periods of volatility that we've seen in the past 12 years. But what's also interesting is the actual loss rate for CLOs. So typically when you're generating a higher return, you're expecting higher loss rates. But for CLOs, it's actually significantly lower. The reason for that is if you buy a portfolio of bonds or if you buy a portfolio of loans, if any one of them defaults and has a loss, that directly impacts your return, negatively impacts your return. Whereas when you're investing in a CLO, because you're doing it in a structured format, you do not have a loss or you're not impaired until the capital below you is completely wiped out. So in a CLO, the equity typically represents 8 to 10% of the capital structure. So that needs to be completely wiped out before there's a single dollar of loss for the CLO double Bs. And that's why the 10-year cumulative impairment rate for double Bs is only 2.2%, whereas against high yield, it's over 16%.
So one feature, Mike.
Sure. I'd say one main focus should be portfolio leverage.
Yeah.
There are various funds in the market. Many of those funds are levered up to 2 times, on 2 times equity. I think you should probably search for funds, even if their statutory leverage may be higher, but generally keep leverage to 1 times or below. A highly levered portfolio does introduce risk, incremental risk, to a potential holder. So that would be something I would keep a very, very close eye on.
Perfect. I would like to thank you guys for being here. I think it was very insightful. Thank you so much.
Thank you so much.
And thank you for being with us in this episode of Conversa de Fundos. Obrigado, a gente espera que tenha sido proveitoso para vocês e a gente se vê na próxima.